And good morning. Welcome to Breakfast Club. This is John Hutchinson along with Jeff Wood on September 3rd, 2025. We hope you all enjoyed your holiday weekend and didn't work too much on your Labor Day holiday. Uh, we've got a fair bit to cover. We'll apologize in advance. I don't have a weekly income report for you this week. I'll catch up on that next week when we get back to regularly scheduled broadcasts. But I wanted to cover a couple of things that we did last week because of their importance. And Jeff has some obviously data and things to cover with you as well. So, a reminder for those of you who are part of Three Stock Strategy. Our plan is to deliver that to you so that you can enter those stocks on Monday, September 8th. So you look for an email. We'll make sure everybody is up to date if you were part of that program. There's big news coming for the Millionaires Trading Club October live event. I will make sure that everybody's up to date on that as soon as we're ready to roll that out, which I hope will be, or I'm planned to be no later than the beginning of next week, maybe this weekend if I can get things done in time. Yesterday we had the ISM manufacturing report ticked a little bit higher, still in contraction, slight reduction in the prices category, increase in new orders. So generally a fine report. But man, the ISM manufacturing still isn't the one that's moving the market. It's the ISM services, and we need to see that print higher than the 50.1 that it printed last month. So that comes out tomorrow at 10 a.m. And then Friday is Jobs Day. And I know Jeff is going to talk a little bit about the jobs report a little bit later here, so I'll add some thoughts at that time. Treasury yields, big spike yesterday in the 30-year up to 5%. That is worth keeping an eye on. If yields start rising in any fashion across the curve, um, that's going to start putting pressure on stocks. So much of that was related to the UK and deep stagflation concerns in the UK economy, not in the US economy. But those things have a tendency to roll downhill. So we'll come back either next Monday or next Wednesday with a little bit of an understanding of how to read the Treasury market and its impact on stocks. Because it can affect your trades, especially when you're in shorter duration trades, trading for or with expirations that are this week or next week. It can have an impact on the overall market. So we'll take a look at that next week. Last week, I shared with you important earnings across the spectrum from last Wednesday and Thursday. And there were some standouts from this. One of the many trends that I've noticed and was evident in much of last week's earnings reports was a meeting that's meet MEET meeting of the expectations of really the big AI companies. NVIDIA met expectations. They didn't blow them out of the water as they had in previous quarters. But what I found unique about that was if you roll back the clock 1 year, their August 2024 report was not dissimilar. So it seems there may be a cyclical nature to NVIDIA's earnings, which could be related to if anybody ever followed the automobile market, right? You knew there was always the summer shutdown, um, and the summer shutdown and retooling of the automotive plants for the new year models, which would come out then in the fall. Wouldn't surprise me if we discover that there's something similar but not exactly the same occurring with NVIDIA as they or in other chip stocks as they start to make uh, huge inroads in the speed, the size, the power, the performance of the chips that they are producing across the spectrum, not just related to artificial intelligence, but across the spectrum. Uh, so their earnings report was generally fine, met expectations, slight beat in a couple of categories, but really the market kind of overreacting to that a little bit. Uh, the real big ones were Dell and Marvell Technology. Marvell missing pretty badly. I believe the stock was down 17 or 19% on the day. Dell missing, Hewlett Packard missing, Network Appliance missing expectations. So there's something taking place in the tech market that we want to keep our eye on. But again, we want to ask the right questions. Was that season related? Was that consumer related, etc.? If you want to, the big winner from last week was Snowflake, which beat expectations by a ridiculous like 60%. Estimated earnings were 12 cents. They beat earnings by 8 cents. So that stock jumped up with a huge spike on the chart. And CrowdStrike, also with a beat last week. So from the overall tech was a little bit mixed. We saw what we see is big tech still performing well, consumer tech not so much. When we roll over to the retail side, there were again some standouts and some losers. Movado missed earnings. They're a fancy watch company. Gap badly missing earnings. A bad performance in their earnings again. So Jeff, you don't have to shop at the Gap anymore. But Ulta, Best Buy, Dollar General, and Burlington stores all meeting or beating estimates. Dick's was essentially in line, but disappointed on revenue, so the stock went down. But the stock that really stood out to me was Affirm. AFRM is the stock symbol. They are a buy now, pay later company, as I mentioned last week, and they outperform substantially. That is an insight into how consumers are spending money. And if consumers are building up in the buy now, pay later, uh, that looks great on current sales, current earnings for companies that utilize their service, but that bill always comes due. So that's a category that I'm going to do a little bit more research on. There are three core outside of PayPal. There is Klarna, Afterpay, and Affirm. So I want to take a deeper dive into that consumer spending area because if what may be taking place is we have seen this over the last year or so, a resurgence in consumers using credit to pay for the necessities. That never ends well. That is consistent with what took place in 2006, 2007. I'm not predicting a financial crisis here or a financial crash or anything of that nature, but that can lead to a recessionary event. So we want to keep our eye on that. But that being said, it's still a stock that's worth paying attention to and potentially owning. Burlington Stores, a little humor on this one. They had a big beat. Stock jumped substantially after their earnings report. And then my wife Liz was shopping this weekend for back to school since she's a teacher and Halloween, and she went into the Burlington store here in Rochester, Michigan, and she said the shelves were empty. She said that the store was poorly stocked. I mean, they ran out of stuff. So be interesting to see if that's again something worth looking at. But are companies not restocking past inventory because of tariffs? That can absolutely be a cause effect relationship, and it's something that we want to have a better sense of. Generally speaking, from the reading of all of these different companies across various industries and sectors, is stability. Generally, consumer spending has been fine. How they spent may be a little worrisome, but that's a future problem. But for how the economy is sort of moving along right now, the story hasn't changed much. The economy is still relatively stable. It may not be growing, leaps and bounds, but as long as we maintain that stability, that again continues to give the Federal Reserve at least some impetus for staying on a rate cut path to kick off in September. Now, the key in that September report, which we'll talk again about when we get to the what is it about the 15th, 16th of the month, excuse me, is whether that's a one and done rate cut for 2025 or whether that is a start of the real rate cut cycle. And I don't think we'll have a real good answer on that unless or until we see what happens with the Governor Lisa Cook lawsuit to prevent Trump from being able to fire her, which I won't waste time on. But that change in that one seat changes the math on on the voting block inside of the Federal Reserve, the voting portion of the Board of Governors. So it's an important case that needs to be um, decided upon, but it has real impact. So when we get more detail, we'll talk about what impact that could have or will have. But it does change the math for rate cut cycles. So that being said, I want to switch out to a quick chart for a second. Let me move over to this chart here. Last week we were looking at NVIDIA and built out for you a three-rung bull put ladder and showed you how I was basically leveraging the 50-day moving average here. Make sure I don't have purple today. Yeah, I was using this line right here as my starting point, my top rung. Um, that little red candle right there is Friday's action. So we started at the 170 strike and we worked our way down in either 2.5 or 5 point increments. Uh, and you can see NVIDIA never pressured its 50-day moving average. So that 170 strike was very firm, very strong. Yesterday, however, that would have been different. Yesterday, coming back from the holiday, did breach its 50-day moving average. So thankfully, we used last Friday's expiration and not this Friday's, but we can see that there's a little gap in the chart right here. So for the moment, with the number of factors coming into play this week being services report tomorrow, jobs report, and questions around the jobs report on Friday. This is not a week where I would build back in and sort of repeat that level of a three-rung ladder below. I took a look at Netflix. I gave some serious consideration to doing it on Netflix, but the one thing that stopped me was a lack of premium in the current week's expiration. The premiums were just too small. We're trying to be a reasonable amount out of the money. That was reason number one. We'll take a look at Netflix, and I'll show you reason number two. So for those, how do you build and look at these kinds of things? So let me show you what's happening with Netflix. And still a stock that I would want to own, but I would want to be more cautious with trading it options wise. One, we can see a pretty well-defined range building right here. But it's this meeting of the moving averages. So the 20 and the 50 on the daily chart have converged, and we're now trendless. Generally, it used to be true, especially if you were selling weekly options, that this would be okay. This would be largely safe if you were selling this week's option because there's no trend, there's no news upcoming like earnings that would give you that would have a cause effect of a spike, right? A spike higher or a spike lower. Um, what's different, of course, is geared more toward the overall economy news, whether it's the services or jobs report, et cetera, weekly claims, things of that nature, that can move the market and has been moving the market a little more, much more frequently, certainly in August and even earlier this spring. But with these two moving averages having kind of created a deadline right at around the 1200 level, I was saying, well, I'd have to go all the way down here to around 1100. And this is where there was essentially no premium if you were trying, especially if you were trying to use a spread. I mean, the widths were it had to be 5 point wide, and the best you could do was around 9 cents. That's not a trade worth making, even if we were pushing well down below that 1100 level. So, and with a pretty solid support, actually, let me clear those real quickly. A reasonable support level here, maybe at about 1150. Um, this has traded there a couple of times, right? If I match that line up, that still felt too close, right? I don't have enough room here to build in a laddered put hedge. So this week was kind of like for me, a no trade week. Remember, not trading is a form of trading. So I would want to stay risk free as much as I possibly could this week. But that being said, if we go back to the presentation. Last week's trade was I gave you a 2.5 and five wide options trade examples. So here we had the 170 by 167.50, 165 by 162, and the 160 by 157. All of those, if you were really uh, ballsy, all of those would have expired worthless. So your max could have been what, 74, $88. But they all would have hit these targets. They would have either have hit 10, 5, or 0. So a net return on $73 on $660 in capital in just 2 days. And that was just doing one contract per trade. So you didn't have to be nutty or crazy about it. That and excuse me, that one and try again. The five wide would have done the same thing, hit all of its targets. We had the top strikes at 170. We split strikes here. We split the 165 and 170 with the 167 and a half. And then we did a 160 by 155. So again, all of these would have expired worthless if you were willing to hold until the end of the day on Friday, which would have been a very good return. 100 and what is that? A 106, 169, $169. But even at that, we still would have had a 154 on $1,300. So an overall 11% return, even with the good till cancels that or buy to closes that we had provided to you last week. So that's a good example of using a put spread in a ladder format, even though a company is reporting earnings as they did, as NVIDIA did. Next week, if we get some stability in the market, we'll try again. I did look at the SPY, both for potential for a bull put spread or a bearish debit spread ladder. That's buying puts in spreads in spread increments rather than selling calls. But again, I felt the strikes were not giving me enough of a payoff, number one. And it was a little too challenging to really build a 2 or 3 or 4 run ladder down. And it was essentially gambling. In other words, I still don't have a clear trend in the S&P 500. And so, though I might think that the services report may disappoint or that the jobs report may be blah, right? I'm gambling on that outcome. And
you save your gambling for Vegas in October when we're all there for MTC.
I agree 100%. So, with that, let me turn it over to you, Jeff, and bring us home with what you have today.
All right. Good morning, everybody. Let's just see what fun Zoom and PowerPoint have in store for us today. And it's already not why. All right.
Just click share.
I clicked share. I don't know. Okay. We're going to, like how it normally gives you a window, like it's giving me full screen. Like I just want to show PowerPoint. There we go. I don't know. I don't even know what you're seeing now. Okay. Hopefully you're seeing economic calendar. Is that good? All right. Good. Good morning, everybody. All right. So just as John mentioned, we are going to talk quickly about the economic calendar for the rest of the week. The big one that everyone's kind of looking for, well, I mean, yeah, it's jobs, JOLTS job opening today at 10 o'clock. Then so all about the jobs this week. Then ADP non-farm payroll, unemployment claims, that's a weekly thing. And then we get unemployment rate on Friday. And what I wanted to kind of draw your attention to is, what part of the reason what's causing all the sort of uncertainty and everything in the market right now is now if everything stays within forecast, everything's fine, but it's when things kind of go outside of the forecast that things get a little wonky. So the forecast currently for the job openings is less than the previous month. So not good, but also pushes that sort of the need for a rate cut a little higher. That should be coming later in September. Um, the ADP non-farm employment change way less than the previous. Some of this again is seasonal, whatever. Unemployment claims higher than they were before. Again, that's a weekly thing, unless they're getting up in that 300. Like, it's more important to look at the 4-week moving average of unemployment claims than it is the weekly number. And certainly when we're talking about the big sort of recessions or anything like that, we're in the 300 to 400,000 a week, not the 230. So this is quite normal, even though it is a little higher than it was last week. The services PMI, if that goes up, that again, anything over 50 is expansion, so that's okay. But it's some of these other ones where unemployment rate creeping up to 4.3%. That's where we start kind of seeing some of these things that we don't want to see. So again, if everything stays within the forecast, even though the forecast is showing some negativity, it should be okay. But if we start seeing something crazy, then that's when we could see a market move either higher or lower very quickly. So that's why there's a lot of uncertainty, and we tend to get these on these job openings. I know Dave always says like, hey, there's a reason not to trade every day, and that's true. So I don't want to scare anyone away, but it is important to know, especially if you're trading zero DTEs, you definitely need to know the time of when these reports come out, because that may, that'll impact volatility. And then the other thing is, I don't, say all these things to scare anyone, or I don't think the market's falling apart by 20% or anything like that. But what I am saying is that this is one of the reasons why the VIX is a little higher. When the VIX is higher, it's actually good opportunities to sell options. We've been successful, but it's been harder to find those good premiums when the VIX is really low. So this actually is giving us an opportunity. It's not something to be feared, but you do have to be a little bit more careful about the stocks that you're picking, maybe position sizing, and maybe, how close, if you're really confident in direction, then fine, choose your deltas accordingly. If you're not sure, then maybe you back off your deltas a little bit with your trades.
I think
John, anything on the,
yeah,
yeah.
the from the dad files, my dad shared some thoughts on this. His worry, and this may or may not be other people's worry, his worry is that the jobs report is going to contain a revision to the upside that will effectively wipe out the majority of the revision to the downside that took place in August.
Oh,
Number
all
one.
right.
And number two, that the jobs report number for August will be a number that nobody would expect, in the like 140 to 170 range. So there is a concern developing, not confirmed, of a manipulation of the data now that they've replaced, or that they're in the process of replacing, the previous head of the BLS. So if the jobs report comes out and the numbers are what feel normal, then I think we can probably look past that. But there's already been discussion about eliminating the monthly jobs report, um, both from Trump and from the person that he tabbed to head up the BLS. The Wall Street needs that report, and those revisions were not uncommon. Similar revision had occurred last year. Similar revisions have occurred in years past. So, and the really ironic part is that those revisions actually bolstered the case for the Federal Reserve to cut rates.
Yeah, I was gonna say, if they know Powell at all, they'll keep the numbers, where they'll keep them low, or at
Low,
least within their
exactly.
forecast. If they come up to 140, then Powell's gonna say, okay, the market's great. We
Yeah.
don't need to cut rates then,
So
not on the Fed board. It's not all just one person.
but ultimately the unemployment rate is one to keep an eye on. If that keeps ticking up toward 4.5%,
Yeah, right. Yeah.
That's going to start to create some issues. So anyway, onward. I know you want to talk about Google
Yeah,
and
yeah. I just have a couple of things
seasonality.
to go through. So seasonality, just in September, this is what pretty much all the news outlets are talking about. It is something, it's something to watch and be aware of. But again, and I put that in the chat actually last Friday or Thursday, whatever, whenever the last time we met. You know, the market can do something 75% of the time or 75% over the last or whatever 70% over the last 10 years. So 7 out of 10 years it can move up. That doesn't mean that it's going to continue to move up, but it is something to be aware of. So September, why everyone talks about, September is it's
The
in
worst month.
recent
Just
years
say it. It's the worst month.
in recent years it's been a little challenging. And so we see some big numbers of -4.5%, -9%. Again, 2022, that is kind of, I mean, we all remember 2022 at this point. And then some of these other ones, were just kind of breathers from good June, or yeah, I mean, look, June, July, and August were also really good back in 2020, 2021. So we just had a little bit of a breather in September. Other news stories, whatever. The important thing is, as we head into the last quarter of 2025, which is absolutely nutty for me to think about, that we're already in the last quarter of 2025. The good news is we get through September, and then we have October, November, December historically have been really strong months in the market. So you just got to be patient. Let's get through the murkiness of September together, and then we'll be on to other things. And what I wanted to show too is September actually is 50%. This column, this column here, September, this row, is in, I believe this is 14-ish years of data, 15 years. No, it can't be 15 because that would be an odd number. Anyway, it's 50% positive, 50% negative. So again, this isn't something to be feared. It's just, let's level set expectations when the average is a little bit lower. So you might still see a positive September. It's just, again, going back to this, we got a lot of really big red numbers that factor into the average. The average is a negative number, because when it gains, it only gains a little bit here or there. So anyway, that's the important part, is just just be a little bit careful out there with position sizing and how you're setting up your trades. But it doesn't mean that it's something to walk away from. So one of the things that everyone's saying, I can't even tell you how many emails I got over the weekend from different news outlets talking about this. So this is what everyone is saying, is when the market is up over 1% in August with new highs, and that all did happen, then September is always going to be a down month with an average of 2%. Well, if that's the case, the good news is we had almost a 1.5% day yesterday. So we're going to be at the monthly lows. But anyway, if everybody knows that though, and that's what everyone is pushing, then yes, sure, the algos could push us to that point. But those types of moves, based on historical averages and statistics, those tend to be self-fulfilling, but they also tend to be very quick dips that provide buying opportunities. So just be wary of, or I think that's just important to note, is that even if we do see kind of a push lower, I'm not seeing that this is I don't see it as opening up to overall bearish behavior or anything like that. I think we could just see sort of a self-fulfilling prophecy with everybody saying the same thing. So now everyone's putting on bearish trades, and then once that happens, the other side of the market comes in and balances things out. So just wanted everyone to know about that. As far as overnight movers and why the market, at least I'm still pulling up Thinkorswim, but at least this morning the market was looking like it was positive, or at least the NASDAQ up over 0.5% in pre-market. The reason is that Google, or Alphabet as they're called, they are currently up over 5%. There was some antitrust ruling that said Google does get to keep Chrome, which is a source of a lot of revenue. And then Apple gets to, they get to continue to get Google, pay Google as for using, sorry, Google is paying Apple for allowing Apple to have Google as the default search engine on Safari. So Apple gets more money, Google gets to keep their browser, everyone's happy. So between two of the major, Mag 7 stocks are up pre-market. That is helping raise the NASDAQ since Apple and Google are major weights in the S&P 500 and the NASDAQ. No surprise that at least in pre-market, both of those two indices are moving higher. As far as the other stuff that's going on, part of the reason why we had what we had yesterday and kind of where we are the rest of the month is, well, maybe we can't all agree on this, but United States is in a financial mess. It's not just one president or another. We've been spending more money than we've been saving. So if the tariffs, which were voted as unconstitutional or whatever whatever the ruling was, whatever the exact wording was, if the tariffs are going to end up being due back, that's over $100 billion that has been collected due to tariffs. That would have to be sent back. Well, U.S. doesn't exactly. We're not flush with cash unless we go print more. And you also have to remember that we talked about this, actually, one of the first sessions that we talked about on Wednesdays, or in Breakfast Club, was the one big beautiful bill. Well, that whole thing was supposed to be paid for by tariffs. So if the Supreme Court rules tariffs unconstitutional, or that the power that was used to put on tariffs unconstitutional, all that sort of stuff, which I kind of doubt, to be honest, but if that happens, then we got some real financial issues because who the heck is paying for the one big beautiful bill if it's not by tariffs? And then we saw this a little bit with the bond market yesterday. If the U.S. can't pay debts, then bonds become junk. We had a little TLT sell-off. Yields moved higher. So it's just a lot of unknowns once again around tariffs, and market doesn't like unknowns. So we had a little bit of a walking into the first day of the fourth quarter yesterday and kind of tripped over ourselves a bit. So there's just uncertainty overall. John talked about it earlier with the Fed board. Will they, won't they, fire, replace, all that good stuff. What will that do to, the composition of the board, all that good stuff. Rate cuts, seems like they're going to happen in September. We don't know until it does. Again, tariff uncertainty, jobs report. So as a result, VIX is moving higher, but again, one day is not a trend to make. So that's kind of where we are this week.
Can you bring up Thinkorswim?
Yeah.
Let's play with a little bit for a quick second. See how this works out.
Stop share. All right, where do you want to go?
Go to GOOGL.
Oops.
So looking at my chart, and you don't have moving averages on there. We've got a nice
I don't.
separation between the 20 and the 50-day. Google riding that most recent leg higher is riding just right outside of the range of the 20-day moving average. This is one where you might look for a potential 2-day trade using a laddered put spread. In part because there's the bottom. I can't see it on Jeff's chart
I
because
know,
he's
because I'm trying to get my
blocking me, but
you
that's okay for the moment. Google has built a very nice upward trending channel with sort of a clear line of lows over the last 3 months. Well, 2 months since the mid-July lows. So a pretty solid channel, upward trending channel there. And obviously that antitrust news, the fact that Google doesn't have to sell off Chrome essentially or split off Chrome, was a big positive for the company. And again, weighing the risks of upcoming data, like Jeff mentioned, Dave says you can always talk yourself out of a trade any day of the week. But here's one where we might take a look at, is there a potential for a trade here? And if we go over to the options chain, we can take a look at some pretty reasonably decent premium on some small spreads that are far enough out of the money to give you some safety. So if we started on the 5 September, selling the 210, buying the 207.50. You got a 2.5 wide there um, to start, and that's 90, 88, 88. That's what I was seeing, about 90 cents, but 88 is pretty good. And then you can add in the 205, 202.50.
All for 5 September.
Yeah.
Okay. I will as soon as Thinkorswim decides to start thinking again. Okay, what do you want to do? 205, 202.50.
Yep.
Okay.
And then the 200, 197.50. So the numbers are very similar to what we built last week when we were looking at NVIDIA. A little bit of difference here or there, but on the 2.5 wides, you're getting a lot more on the 210. You're still roughly 4%, 4.5% out of the money on the top strike. But that's what is dollar three,
We're
dollar
talking.
43, dollar 41 max, right? Dollar
Oh yeah,
41
sorry, hang
in
on.
2 days.
It's throwing me all off.
Roughly again, 600-ish in
Yeah,
capital.
750 minus the $1.41. Yeah, so 600.
So again, another reasonable possibility if you want, again, if you're paper trading, test it, see how it does again. If you want to take a little bit of a risk, don't do more than one contract. No need to. But that's another $141 possible by this Friday. And again, I would be similar in setting a 10 cent, 5 cent, 0 cent buy to close target from top down. But there's another ladder put spread on the credit side that could be used using the momentum that Google has moving into the today's market in your favor, and then frankly hoping that data tomorrow and data on Friday don't upset or upend the market. If that 210 level starts to get pressured in any way, I would just close out. Keep the loss to as minimal as possible. Um, but that would be my approach on that one. Jeff, do you have a different view, or how would you look at that?
No, I think it's just a matter of we'll have to see what the prices are at the open. But yeah, I mean
No,
it's already, um, Thinkorswim is showing 226 in pre-market. So just in case anyone looks at the chart and you're like, you know, why in the world are you putting on a 210 when it's only, trading at 211 or whatever? That's just because on the chart we haven't seen the pre-market value, but in the options in the analyze tab, this is where the current market is, which is 226. And John's first one set that first put spread that he set up was 210, so it's way over here. This marker is a 10% to the downside. So if Google falls apart in the next 2 days by 10%, you're looking at losing a max of $261. So as long as Google doesn't fall apart by 10% in 2 days, uh, then there
everyone
you
will
go.
be okay.
Yeah, then I mean, so your overall risk to reward, I mean, let's assume that Google's not going to fall apart by 10%. Or let's just assume that it does, whatever. Your risk to reward is $141 on 241. So not too bad.
All right, let me get a quick snapshot of that one going in. And I think that'll do it. Don't have any questions, so we'll call that a welcome back breakfast club. And we have Millionaires Trading Club at 11 a.m. today and Income Masters at 12:30. So we will see you in your live trading or training session today, and hope everyone has a great rest of the week. And we will be back with Breakfast Club next Monday at 8:30 a.m. Thanks everyone for Jeff and for me. Have a great week.